Hello and welcome to Skaflic. Today, we'll talk about Skaflic investment insurance. Investment insurance, also referred to as a variable universal life insurance plan, is a cover that provides an investor with financial security and financial growth. The investment insurance concept is broken down into two broad categories: an insurance part and an investment part. In the traditional kind of investment, an insured party only receives the agreed benefits of an insurance policy upon the occurrence of the insured event. For investment insurance, a beneficiary receives returns even before the occurrence of the insured event, depending on the agreement between the two investing parties. For instance, weekly, monthly, semi-annually, or annually. Investment insurance works in a very interesting way. It emerges as a double-in-one investment. When an investor services their insurance premiums, after a while, when the amount is significant, part of the premiums is converted into an investment. And as the value of the premiums increases, the investment grows. This generates a return on investment, or ROI, making it possible for an investor to receive income before the occurrence of the insured event. Even as this happens, the actual insurance remains active, and in the unfortunate scenario the insured event occurs, the investor gets compensated as per the agreed policy coverage. Needless to say, in the case the heavens smile upon you and the unfortunate event does not occur soon, you continue enjoying income from your investment until when it does, after which you receive the agreed compensation. Benefits of investment insurance: high returns. Investment insurance is designed in a manner that maximizes investor earnings through the investment, unlike traditional policies where one only benefits from a single payout. No compromise on your policy. Investments are governed by market forces and are not immune to loss. This may change an investor's ROI, which stems from this premium value. This will, however, not affect the insurance policy in any way. Benefit from extra premiums. Higher premiums translate to higher returns. An investor reserves the privilege to pay more premiums than the agreed minimum, which will be added to the investment. Why is Skaflic offering investment insurance services? Skaflic provides investment insurance for those investors who do not want to risk their money at all. With Skaflic's investment insurance, investors can mitigate the risk of losing money. In the event that an e-store from the Skaflic store platform did not perform as expected and fails, the store investors will lose their investment. Because of that, Skaflic secures investors' assets through investment insurance. Investors can still recover their investment through Skaflic's investment insurance, other than the risk of making returns on their investment for a longer duration than expected in the scenario where their investment does not respond positively to the expected projections when setting up the investment. The global economy is faced with various factors that determine the outcome of any investment, such as competition, bankruptcy, economic recession, interest rates, and the like. When an investor invests their money in a business that is listed on Skaflic's ICO platform, they are guaranteed to make returns on their investment. People may ask, how? Let's say Sam invests $10,000 in one of the e-stores listed on the Skaflic ICO platform. Despite a prior analysis of the e-store by Skaflic indicating that it's a worthwhile investment, the business may fail due to many different factors such as stiff competition, entry of new players, a global pandemic, and alike. This particular e-store may fail, but the investment agreement Sam has with Skaflic remains active, and Sam will continue making money. In the $10,000 Sam invested in the e-store, Skaflic will invest maybe $5,000 in other businesses on its platform. Example, other online stores, bonds, and so on, which will keep generating income, which will in turn be used to service the agreement with Sam despite the failure of the business he invested in. You may be wondering how Sam is going to recover the $5,000 that was lost due to closure of the e-store. Well, here's how. Let's assume the agreement between Skaflic and Sam was that he would be receiving a 9% annual return on the investment he made in the e-store, which has just run out of business. Through the investment insurance, he'll still receive $450 annually, $5,000 times 0.09, and in 11 years, Sam will have recovered all of his lost money. Despite the investment in the e-store not turning out as intended, Sam finally gets to recover his money. The only downside being that it took longer than expected. The idea behind investment insurance is that investment mistakes will not result in investors losing money. It will also help educate investors about ways of evaluating any projects and empowering their investment mindset on how to manage their investment portfolio. Moreover, investment insurance gives investors a good future value when they calculate the future value of their money.